Welcome to Financial Insider Weekly. I'm your host, Michael Gray CPA. My guest today is Craig Martin. Craig is a certified financial planner, and he works in his family business, which is called the Family Wealth Consulting Group. They are fee-only financial planners, and he works with his wife Peggy and his daughter Hillary, and his other daughter Alyssa has recently also become involved in the business.
Yes.
So congratulations on that.
Yeah, it's fun.
Good for you.
I don't get any votes, but
let's just say you get overridden every time. Okay.
yeah.
Anyway, Craig's been providing asset management services for over 31 years. I've known him for a good many of those years.
Yes. We've raised our kids with commensurate stories, haven't we?
Yes. So, Craig, welcome and thanks for joining me today.
Yes. Thank you for inviting me. I'm always honored to come. You have interviewed some very famous people in our community, and I'm proud to be a part of that list.
Well, thank you for that, Craig. Now, Craig and I today are going to be talking about alternative investments besides stocks and bonds, and I guess I'll also throw in besides savings accounts, which would be the most conventional of all.
Yeah, I define alternative investments as anything but stocks or bonds.
Okay. And Craig's company recently has been really actively involved in offering other alternatives. Craig's been sort of trailblazing in that area, which means that he probably has a few arrows in his back that he can share with us.
Several. Yes.
So,
yes, we've put together a special fund. It allows us to collect our clients' monies and invest them in alternatives. And a client can determine what percentage of their portfolio they want to put in, and then they can choose which investments they want. It is not a pooled investment program. And the fund goes on indefinitely.
Yeah. Okay, so today we're going to be talking about the role of these alternative investments in the overall investment picture, and a little bit about why Craig is doing this. So Craig, why should people consider making investments besides stocks and bonds in building an investment portfolio?
Well, stocks and bonds are the classics. Truly 99% of the stockbrokers in the world are still trading mutual funds or ETFs or REITs. Marketable securities is their key byword. It has to be marketable. What we're doing is bringing different asset classes to the client, something besides all of that. The good news about that kind of investment is that the longer you buy it and hold it, the better the returns will be. They have been close to 10% per year. I would expect over an investor's lifetime for returns to approach that number again. The secret is buy and hold, by the way. However, in the last 10 years, investors in the securities markets have suffered two huge market downturns, approaching or exceeding 50%. Whoa!
Yeah.
Such that for the 10-year period ending 2009, the S&P, representing that broad market, was down 1% per year net. Okay? So for investors who have been in that market and suffered those market downturns, alternatives are a way of saying, if I didn't have 100% of my money there, I'd feel better. And if I can find alternatives as an investor, something besides stocks or bonds, when the stocks go down, hopefully my other asset classes are doing something different, hopefully stable or going up in value. Okay?
So anyway, we're adding more different assets to the mix, and is trying to reduce that jiggling that's going on of the value.
I like the term jiggle. That's a very, very good.
It's a technical term.
Art. So give you an example. In 2008, market went down by 35%. totally it went down by 50+% for over a 1.5-year period of time. But in that calendar year, stocks went down 35%. Managed futures, something that are not stocks, managed futures went up 30%. So just as a scenario, if you had 50% of your money in stocks and 50% of your money in a cross-section of those managed futures, you would have had the stock market go down 30 and the managed futures to go up 30, and your total portfolio would have been flat. What a good feeling, huh?
Yeah. Well, it feels a lot better than seeing it all go down.
Yeah.
So yeah. Okay. So that's the idea, is by, again, adding more asset classes to the mix, it helps to have a little more consistency, hopefully, in your returns in the long run. And not only that, but again, less deviation in the value of the entire portfolio.
Yes.
Okay. And so, and the next question was, is that because stocks and other investment alternatives have a dissimilar price movement with similar returns? So I think you sort of gave an illustration of that.
Dissimilar price movement, that's good.
Yeah.
So dissimilar means that we use the term correlation coefficient.
Okay.
So
that's a statistical term, by the way.
A statistical term that says that the price movement is correlated. Well, how is it correlated? If the price goes up on A 1 unit, if the price goes up 1 unit, then what happens to the price of B? If it goes up 1 unit, then it's 1-to-1 correlated. If it goes down 1 unit, then it's a -1 correlated. Can't be greater than +1 or -1 correlation. It's got to be someplace in between. And 0 is randomly correlated. So yes, we look for asset classes that are different than stocks or bonds, and we add them to a portfolio. What it does is it reduces the volatility of the total portfolio, the price movement that goes up or down.
Right.
It reduces that range of positive and minus returns and makes that range smaller and smaller the more effective we are at adding dissimilar price movement asset classes to the portfolio.
Right.
So we're looking for asset classes that have dissimilar price movement to stocks. We don't want 1-to-1 correlation. We want 0 correlation, or better yet, maybe a slightly negative correlation. Okay?
Okay. Why don't we move ahead for a moment here and talk a little about efficiency for investments. So how does the efficiency of the other investment alternatives compare to the efficiency of the stock market?
Well, let me talk about buying an individual stock and the volatility of returns that if you own any individual stock. We typically monitor that such that the returns of an individual stock go up 30% and down 30%, but average 8, 10, 12% returns over a long period of time. The way to reduce the volatility of owning that one stock is to buy a whole bunch of stocks that have similar return risk-reward ratios. They all get about 10% return per year, but they go up or down at different times. So a mutual fund of 500 stocks, large cap stocks, doesn't have 30% volatility. It has closer to 18%. We've almost cut that volatility in half by adding 500 stocks into a mutual fund, and we get the same returns as that individual stock, but we suffer less risk. That is an efficient risk management technique. Instead of buying one stock, we buy 500. We get very similar, if not better, returns, but we do it with a lot less volatility. How much more reduction in volatility can we get by adding alternatives to that asset class, to those stock portfolio mutual fund? Well, if we add managed futures, about 20% managed futures, historically what's happened is we get more return, 11, 12% return instead of 10. That the stocks are getting 10, but if we add about 20% managed futures to that, we get 11 or 12% return, and that 18% volatility goes down to closer to 15, 14.
Mm-hmm.
Significant, statistically, reduction in risk of that portfolio. So we've increased the return of the portfolio by adding alternatives, and we've reduced the volatility.
Okay.
So I can start with a single stock and cut it in half by adding it to a bigger mutual fund of stocks. And then taking that mutual fund, I can add alternatives to it. And if we start with up to 20% managed futures, we can increase the return of that portfolio and reduce the risk of it. Varies what I would call an effective risk management technique.
Right.
The alternative is to add 500 more stocks because it doesn't reduce the volatility. Likely will reduce the return.
Now another thing then related to efficiency, and I think what you just shared is really important as far as reducing risk and managing risk, and that's been sort of the thrust of what you've been doing for many years, and part of the reason why we've been associated with each other. But the other thing has to do with efficiency related to information and other things. In other words, the efficiency of the stock market itself.
Oh.
And
so good. So the question is, so let me make a declaration that the stock market is increasingly efficient. By that I mean that the information that's available in the stock market on any individual stock is widely dispersed across the community. Everybody's got the same information. There is no legal insider information.
Yeah, so maybe we should emphasize is this legal thing. Yeah. So legally, there's not supposed to be insider information, okay? Yeah. And so when people are thinking, everybody else is getting this break, and they're hoping to get a hot tip from their stockbroker or whatever.
No such thing.
And so the point of the matter, and they've done a lot of studies, but basically the information gets around very fast.
Yeah, any stock trades tens of thousands of times a day or more. So to assume that information you read in the newspaper when you get home at night, you could trade on it the next day, it's way too late. Whatever information you read in the newspaper about any stock or market has already been included in the prices that were traded. So when that information hit the street, within one or two or three the next three trades after that information was available, that information was included in the price. We say the price is perfect based upon the information that's available. So to assume that anyone could study the same information that everybody else has available and consistently get information, decision-making information that's different than what the rest of the world is getting is an unrealistic assumption. So this is an indictment of the brokerage world, but if you're hiring a broker to pick stocks and time the trades or buy the best stocks or the best mutual funds at any one time, you're saying that this person can study the past and know the future. And we don't know anybody that can do that. We don't know anybody that can study the past information, the existing information that's available to everybody in the marketplace, and know something that the rest of the world doesn't know. We just don't know how that can happen, and statistically it has never happened. All of the brokerage world ultimately underperforms the performance of a simple index fund, a buy and hold of the whole marketplace. Okay.
Now let's talk about this, because we're going to burn a lot of time here. Okay. So Craig could talk about this for days. But let's talk about efficiency now in the same respect related to, say, a piece of real estate. So now we have a different
an alternative
picture.
Investment.
Yeah.
So if the stock market's efficient, is real estate efficient? And my answer to that would be no. If I look at the performance of an index of real estate managed addresses, then what I see is returns in the 8 to 10% range over the longest periods of time. But I can find managers who are offering private deals in real estate who have 20, 30, sometimes 40 years of track record of earning 20% returns per year. I can't find that in the stock market. I can't find people that are trading in a declared efficient market and earning, over the longest period of time, earning more than a simple buy and hold of the marketplace. In real estate, I can. I can find managers that are maybe doubling the performance of a simple buy and hold or more. I can find the same thing in managed futures. I can find it in option trading instances. So there are inefficiencies in markets that compensate me as a financial planner to go out there and find those managers that can find those inefficiencies consistently over a long period of time. I would rather find a good real estate manager. It takes me much less effort to find a good real estate manager than a stock picker, because I can't separate what the stock picker is doing from luck, because he doesn't have a consistent performance. But I can find that in the real estate, the alternative market.
All right. So time is going.
I
Darn.
talk too much. Yeah.
But let's talk a little bit, maybe in a little more detail, as far as what is the difference between the public and the private real estate markets, and what are some advantages and disadvantages for each?
Public real estate market is traded normally traded on the stock exchange. It's called REITs, Real Estate Investment Trust. It's a share, again, like a mutual fund. Manager buys real estate and issues shares for the people that invest into it, and those shares are traded on the New York Stock Exchange or such, and those prices go up or down based upon what the market thinks that real estate's worth. It's my experience that that's not how real estate works. That's how the stock market works, but it's not how real estate works. So private real estate doesn't have that marketability. I can't sell interests in a private fund managing real estate.
Right. So this is an illiquid investment.
It is illiquid.
Yes.
If you put all your money into one project, it's illiquid for the length of that project. Secret to what we're doing is putting small amounts of money into a string of illiquid investments, such that part of your portfolio ultimately ends up to be permanently liquid.
So it's just turning.
Yes.
All right. Now, many people have made money in Silicon Valley by buying and holding real estate for many years. Would you recommend that as an ongoing approach?
Great for them, not so great for us. It is still typical for some investors to think that real estate does not go down in value. We all know it does now. And anyone who we're advising a client right at the moment who has a property that's worth less than the mortgage on the property. The question is, should that client pay down the mortgage so that they can get a refinance and a lower interest rate? And my absolute answer is no. Why would you put money into a depreciating asset? I don't know when the value of real estate's going to recover at his address. So for us to look at real estate and think that it's always going to go up, no, that's not true. It's like every other investment. It goes down, it goes up, and if properly managed in a diversified portfolio, it makes a great investment.
Okay. So we've been talking about a number of these different things and the aspects, the interrelationship or interface of the different conventional investments, if you will, and then these alternatives, and how it helps to keep the value of the, if you will, the investment base, the capital, a little more stable. So what is the significance of that, particularly for people when they're into a retirement mode? Well,
typically people in retirement ask how many bonds should I own to earn my retirement income? And my response to that is none.
None?
None. Bonds should never be purchased for income purposes. They should only be purchased for portfolio stability purposes, because income should be taken from equity long term. In other words, bond yields today are in the 1 to 2% range. Over the longest period of time, they've averaged 5%. But equity growth has been at 10% per year. Would you rather spend from 10% growth or 5% dividends? I mean, really. A risk-managed portfolio. Earlier we talked about reducing the volatility of a single stock from 30% up and down to about 18% in the Vanguard S&P 500, which has 500 stocks. And then if we add managed futures to that contract, it reduces the volatility even more. So it turns out that a portfolio earning 10% with 30% volatility and a portfolio earning 10% with 18% volatility, the portfolio with 18% volatility, the lowest volatility, has higher terminal value. You put $1 into both of them, while they both earn 10%, the one that's got less volatility grows to a bigger value than that which has got higher volatility. That dollar has a tough time recovering from a minus 30.
Right.
Okay?
So in other words, you're taking draws, you're taking money out of this when you're into the retirement mode, taking money out on a regular basis because you need to pay your living expenses. If you're taking it out of a fund that has a 30% volatility, that means that you're going to be taking some of that money out at different low spots. It just can't recover
as easily.
And so, but if you've got a much lower volatility, that means that it's not going to be at such of a reduced value. And even though it may not go as high, because you haven't taken it out at such a low value, somehow it's going to end up having a much higher terminal value.
So what we see is that the mutual fund with 18% volatility but earning 10% on average per year, over the past 40 years, the most you could withdraw from that portfolio was 4% per year.
Right, that's sort of the guideline that a lot of people have been saying, is that you could take 4% out.
Yeah. How much can I spend out of my equity portfolio and hope not to outlive my money?
Right.
I want that portfolio to last forever. So a 4% withdrawal rate in a 10% growth rate portfolio is the max you can withdraw given the volatility of the portfolio. Okay? If we add managed futures to that and reduce the volatility to about 15%, that payout percentage goes from 4 closer to 6. We just increased the payout by 50%.
Yeah.
I didn't buy more bonds. I didn't take more risks by getting higher interest rates in a low interest rate market. What I did was I managed the risk of the portfolio. We're risk managers. So to maximize the income that can be paid out of any diversified portfolio, the goal is to reduce the volatility. We want to reduce that volatility from 30 to 18 to 15 or less. Okay? Because I can increase the payout rate in that portfolio from 4% per year to 6% real easy, real simple, just by adding about 20% managed futures. How about adding real estate? How about adding options? How about getting 30, 40% of the portfolio into alternatives? Gosh, lots of alternatives now lots of opportunities for us to talk about using alternatives as a risk management tool. And what it ultimately does is increase the terminal value in your portfolio, the ending dollar value, and dramatically increases the amount of payout that you can expect during your retirement years.
Okay. We only probably have a couple minutes left, Craig, just to sort of cue you in.
Short answer.
But maybe and I know this isn't fair, but gold is hot these days.
Gold.
maybe you'd like to comment for 30 seconds about gold.
Yeah, how many, we just had the Facebook IPO also. Why, should everybody have invested in Facebook? Well, now the story is, gosh, how sad it was for people that did.
Well, but the story's not done there. I
way.
mean, maybe 20 years from now, it would be a great deal.
So we talk about the efficient market, and the efficient market basically says that we don't know the future. The best we can do is read about what's happened in the past. But what's the future price of a stock or Facebook stock or gold is just unknown. I just can't tell you what's going to happen to gold. Mm-hmm. What I know is that over the longest period of time, gold has underperformed inflation for about the past 150 years. Jeremy Siegel, professor at Wharton, did that study. And what he showed is that gold underperformed inflation. Mm-hmm. So a simple buy and hold of gold is not an investment. I can get savings accounts that do better at the bank.
Okay. Craig, thanks so much for joining me today.
It's been fun.
I think we've hit some really important material, I hope some valuable things that are going to provoke some thought for people, and particularly maybe some interest in exploring these investment alternatives. And so that's what we're trying to do today, is give you some education in this area. This is just an introduction. And so for more discussion, I invite you to get together with a financial planner or your investment advisor. And folks, be careful out there. Remember, investments involve risk. And so Craig's approach that I've been interested in is in managing that risk. So with that, we'll see you next time at Financial Insider Weekly.